yesterday we learned that Canadians are spending more of their income to pay down debt than they ever have before, at least since Stats Canada started collecting data on what's called the household debt service ratio. That tracks the total payments, both principal and interest, that Canadians pay as a portion of their disposable income. That number has surged since the Bank of Canada began raising interest rates, and it now stands at more than 15%. So a lot of people very curious about how that factors into the Bank of Canada's interest rate plans for 2024. Let's bring in Royce Mendes. He's Managing Director and Head of Macro Strategy at Desjardins. Royce, it's great to have you with us. We just did a segment on what the expectations on the rate front look like in the United States. Let's talk about the debt picture here in Canada first. What did you make of those new stats on how much of Canadian income is going towards simply servicing debt?
Look, they're ugly, but not surprising. If you think about how many of these mortgages have renewed in this higher interest rate environment, it's really not surprising to see the debt service ratio rise. Canadians are spending more and more of their incomes to service their mortgages and other debt products. And essentially, they're spending less and less in the rest of the economy. And that's why we've seen GDP stagnate for a couple of quarters. Real spending per capita is actually contracting. People are generally just pulling back in all forms of spending other than servicing their debt or trying to pay the interest on their debt, because they're really not even paying that much principal anymore in many cases.
And if rates were to stay at their current levels, one of the things you've talked with us about in the past is, given our shorter mortgage cycle in Canada versus the United States, that this is going to be an issue as more and more people refinance over the next few years?
Absolutely. I mean, if rates remained where they were in, let's say, early October, the wave of mortgage renewals would have left us in a pretty severe recession. I think there's little question about that. That said, I mean, interest rates have fallen dramatically in the past few months and just in the past couple of days. So if you're a borrower, you're cheering the Fed right now, and the dovishness that we've seen just yesterday from both the statement, the dot plot, and then Chairman Powell's press conference. Canadian 5-year rates have fallen pretty dramatically. And actually, I think, mortgage rates are going to be sitting at the end of this year where we, who were more dovish than the rest of our competitors probably on Bay Street, we're expecting them to be in March. So you've really gotten a pretty substantial easing in financial conditions, which is good for borrowers, but they're not out of the woods yet. I mean, as we've showed before, the simulations that we've run on these mortgage renewals, particularly as we get into 2025 and then into 2026, even if we're in a slightly lower interest rate environment, they're still going to be challenging for the economy and likely mean, interest rates are going to need to remain somewhat low throughout the next few years in Canada.
So just to reiterate for our audience, you're noting that in the bond market, like the yields that we quote in Canada, because mortgage products are ultimately going to be based on what we are seeing in the broader markets, if there's a growing belief on Wall Street that the U.S. central bank will be lowering interest rates, that does some of the work in giving people the opportunity to maybe get a better deal on a mortgage tomorrow versus 3 months ago. But I do want to come back to the idea of just actual interest rate policy by the Bank of Canada. And a reminder that yesterday it seemed like the message from the Fed was maybe they're penciling in upwards of 75 basis points worth of cuts in 2024. The market seems to think they might do more than that. What is your current expectation for what the Bank of Canada specifically will do with where interest rates are at the overnight level?
We think that the bank will start lowering interest rates around April and then continue throughout the rest of the year in a very methodical fashion. It won't be maybe as fast as it has been in past recessions and may not go as deep. Typically you need to see about 4 to 5 percentage points worth of rate cuts to offset an average recession. We think that the Bank of Canada lowers the interest rate from 5% where it stands today, starting in April, and then moves in 25 basis increments at each of its decision dates and goes all the way down by the end of 2025 to 2.25%. And that's really just to help offset some of the pain, not all of the pain from the mortgage renewals. Mortgage renewals will still see people facing positive payment shocks. So when their mortgage comes up for renewal, even if the Bank of Canada takes the policy rate down 275 basis points from where it is today, they'll still be seeing payment shocks, but they won't be as severe as they would be if the Bank of Canada, for example, had left rates on hold, or market-based interest rates, to your point, had remained where they were at the highs in October. We are seeing progress. We're seeing central bankers acknowledge the progress on inflation, which is great. And we'll see what the governor of the Bank of Canada says tomorrow. He has a very important speech tomorrow. It's sort of an end-of-year recap. And we'll see if he sort of reiterates the somewhat more neutral tone that they took in their recent interest rate decision, or if he follows the Fed's path and takes a more dovish tone. We had expected that they wouldn't turn more dovish until January, when they had a fresh set of forecasts in hand. But now that the Fed has opened the door to central bankers, not only in Canada, but around the world, discussing interest rate reductions, it might give the Bank of Canada a little bit of leeway to start discussing openly the fact that interest rates are likely headed lower, and maybe materially lower in 2024 and 2025 to help offset some of the pain from those mortgage renewals.